Time now for charting futures, and Bloomberg Intelligence Mike McGlone has today's edition.
Thank you, Scarlett. I'm with Mark Newton of Newton Advisors. I feel like I should be pushing you around a little, but we're both ex-pit traders from Chicago trading options. And Mark's going to show us today, I'm ready to write down our trade. You're going to show us crude oil, looking at potentially long calls in crude oil.
Yeah, correct. It's starting to show increasing signs of stabilization after a very severe pullback from the middle part of September. So it declined about 13% in really 13 trading days from mid-September. Now you're down to a level that hit both prior highs, not only from June, but also August. So for those wishing to make any sort of long projection, this is a great risk reward to think, you take a chance at going long, particularly, we've pulled back, we started to stabilize a little bit. So buying calls makes a lot of sense, for those that either anticipate that potentially another attack could happen, or maybe they're going to get supply online a little bit longer than what's anticipated, but technically it makes a lot of sense right at this level.
So maybe we can pull up the next chart and take a look at volatility. If we're going to talk options, we have to think volatility and see how rich or cheap are these would be a call right now.
Yeah, so that's what's interesting is that we've seen implied volatility fall off pretty dramatically over the last couple of weeks. And so it was in the mid-40s, now it's down to right around 33, 34. So that's interesting when one wants to take really a short-term bet. Of course, it's more gamma, not vega. We're only talking about a short-term projection for the move higher. But in general, one wants to buy when volatility is cheaper, and it has pulled back and given us an opportunity to do that in recent weeks.
Now let's shoot over next to option bullets. We have some potential bullets of what to look at in options. You had a specific trade in mind, which is potential call. And what I like about this call, at least I'm more of a bearish person, but you have a built-in stop, which is the premium you pay.
Yeah, so for me, it's more of a tactical trade. Everything's about a risk-reward. I mean, crude is traded in its entire range from October through December of last year. It's pretty much mid-range, so you really want to time when you want to get in, enter, and exit. So, it's pulled back to former support, which I do think is important. Implied volatility's pulled back a little bit. If anything, we want to take a look at buying the December 53.5 calls. You always want to give yourself time frame, a longer time. You don't want to go out too short. So if anything, we're going out about 39 days, which for me is ideal. And you also want to buy something that's really pretty much right at the money, not too out of the money. Obviously, you're going to get grinded up by decay. If anything, you're buying at the money call, slightly in the money. Seasonality has been, of course, bearish, typically in the winter months. However, this is a very different year. Crude actually peaked out in April of this year. It pulled back during times it was normally bullish. Now we've seen a very violent pullback, which I think makes a very good risk reward to take a look at buying calls.